There are several different ways to finance an investment property, and choosing the wrong one could end up costing you thousands of dollars. I'm going to break down common loan options for financing your investment property, who they're designed for, and how it's going to fit your situation. Hey everybody, Nikki Rogers here with Team Nikki Rogers here in North Carolina. Last week, what we talked about and focused on is what actually qualifies as an investment property. Today, we're going to go the next step further and explain exactly what the financing looks like on those investment properties. Buying your first investment property is very different than buying your first primary home. And understanding your loan options is the most important piece of making a smart investment decision. Today, we're going to talk about the two most common investment loan options that we see here in Eastern North Carolina. First, there's no best investment loan. I think the issue is people search online and ChatGPT for the best investment loan. The best loan depends entirely on what you're trying to accomplish and your financial situation. Are you buying a long-term rental, a beach house to rent, a fixer-upper, your second rental? Each of these situations can point to a completely different loan. The biggest factor that you're going to see lenders include are the following: the property itself, expected rental income, your credit score, your income, your down payment, and your overall investment strategy. The goal isn't simply getting approved, it's getting the correct financing to support your long-term financial goals. Many first-time investors start with a traditional, conventional investment financing loan option. We're going to talk about that. Conventional investment loans are generally designed for people that are going to be purchasing long-term rental investment properties. These loans typically work well if you have strong credit, documented income, enough cash for your down payment, and money in your reserves. What does reserves mean? Basically, we're saying savings after closing. These loan terms generally offer long-term competitive financing. However, they are also more difficult to qualify for than your primary residence. Lenders generally require a stronger credit score, larger down payments, additional reserves, and a close review of your current finances and the rental income that will be coming in. So if you're somebody that is looking to buy your first rental property and planning to keep it for years to come, this is usually where we will start and help you look at. The main thing about the conventional investment loan is this: it's the most common, it's very traditional, and it generally follows a lot of what primary residence and second homes ask for. However, what is different is it's an increased credit score, an increased down payment, and really an increased overall picture. So we find that that is generally what people like to start with. But what happens if maybe you don't fit into that mold or that bucket? Are there other options? The answer is yes. And today I want to talk about the number one that we're seeing here lately: DSCR loans. This is the one that's getting mentioned all over social media, specifically trending on TikTok. DSCR stands for Debt Service Coverage Ratio. This loan type is based on if the property that you're purchasing can generate enough income monthly to support the mortgage that you'll be getting on it. Think about it like this: if the property is going to generate enough income to comfortably pay its own payment, that's exactly what this loan type is designed for. These loans are especially helpful for our self-employed borrowers and investors with significant tax write-offs, and buyers where their tax returns do not reflect their actual cash flow. The trade-off on this: they may require a larger down payment, higher reserves, remember that savings account after closing, and potentially higher costs than conventional financing. Now, that sounds like that's more money, more cost, more work. But really, it's what gets you in the game. And if the tenant is going to be making the payment, then they're the ones that are paying that interest rate. They're the ones that are paying back into the money that you've invested into the property. And sometimes your financial situation is you just need to get in the game. So if you have enough funds and you have the required credit score, the only thing we're going to focus on is what that property itself can generate and produce to pay its own payment. So how do you know which one is right for you? This is where working with a lender becomes incredibly valuable. Instead of asking what's the cheapest loan, ask the questions like, is this going to be a long-term or short-term rental? How much down payment money do I actually have? Will rental income help me qualify? How much cash should I keep in reserves? And what's your long-term investment plan? These answers typically point us to the right loan that makes sense. So if you're one of these people that went into the bank, credit union, lender, wherever, and applied for the traditional conventional investment product and you didn't qualify, I want you to know that there is another product out there for you. So if you are even interested in buying an investment property here in Eastern North Carolina or any of the other states we're licensed in, please reach out. We'd love to have a conversation first because these type of properties, it's so important to sit down, have a consultation via Zoom or the phone to make sure that we understand everything up front so we can set you up for success, whichever product is the best for you. Don't forget to like, subscribe, leave a comment, share it. If you think there's someone out there that can benefit from this, share. I'm Nikki Rogers with Team Nikki Rogers here in Eastern North Carolina, and I'll see you at the next video.